Are you making these common mistakes while dollar-cost averaging into crypto? Mistakes that could be quietly sabotaging your long-term wealth? Even if you think you're doing everything right? Today, we're exposing the 5 most costly DCA mistakes in crypto and showing you exactly how to avoid them to build real wealth. Let's dive in. Dollar-cost averaging, or DCA, is beautifully simple in concept. You invest a fixed amount at regular intervals, regardless of market conditions. This means you buy fewer coins when prices are high, and more when they're low. It removes emotion from investing and can be completely automated. But here's where most people stumble. While the concept is simple, proper execution requires avoiding critical mistakes. Success demands discipline, planning, and awareness of common pitfalls that can turn this brilliant strategy into a costly error. The biggest mistake is applying DCA to terrible investments. Imagine choosing a coin based purely on social media hype and a funny logo. You faithfully invest $25 weekly, but the coin has no real use case or development team. During the 2017 bull run, countless investors DCA'd into projects that seemed revolutionary but ultimately failed. They kept buying the dips, watching their investment dwindle to nothing. DCA into a failing project is like filling a bucket with a giant hole. It's doomed from the start. Stick to high-quality established projects like Bitcoin and Ethereum for your core DCA strategy. These are the blue-chip assets of crypto. They may not offer explosive short-term gains, but they're far more likely to survive and thrive long-term. Save risky bets for a tiny portion of your portfolio, not your main wealth-building strategy. Picture this. You've been investing $100 monthly into Bitcoin for a year. Suddenly, a brutal market crash cuts your portfolio value in half. Panic sets in as every headline screams about crypto winter. Overwhelmed by fear, you stop your automatic investments and maybe even sell at a loss. This is exactly the opposite of what you should do. It's like running from a 50% off sale instead of taking advantage of the discount. Successful investors have the discipline to keep buying when everyone else is panicking. The solution? Automate your buys and commit for the long haul. By removing emotion and trusting your long-term strategy, you can weather these storms and emerge stronger. A disastrous mistake: using money meant for rent, car payments, or emergencies for crypto investing. Caught up in bull market excitement, they decide to go all in with money they actually need. This puts them in an incredibly vulnerable position from day one. When the volatile crypto market drops 30%, it becomes a real-life crisis. They're forced to sell at a massive loss simply to pay bills and avoid eviction. This is called being a forced seller, a guaranteed way to lose money investing. Before investing a single dollar, build a fully funded emergency fund covering 3 to 6 months of expenses. This safety net allows you to invest with confidence, knowing you won't need to liquidate during emergencies. Only invest money you genuinely won't need to touch for many years. Starting DCA without clear goals is like driving without a destination. An investor starts buying $50 of Ethereum weekly simply because it feels right. No target value, no time frame, no plan for what to do when they reach their goal. Without clear objectives, it becomes incredibly difficult to stay motivated during long bear markets. Without tracking, you can't make informed decisions about your average buy price or performance. You're essentially investing in the dark. Example: accumulate $50,000 in crypto for a house down payment in 10 years. This immediately gives your DCA plan purpose, timeline, and helps calculate monthly investment needs. Use a simple spreadsheet to track every purchase, total invested, and average cost. This transforms vague effort into a concrete, accountable project that keeps you motivated long-term. A frequently overlooked mistake that silently sabotages returns: ignoring transaction fees. Many beginners use extremely user-friendly platforms that charge very high fees for convenience. Investing $100 weekly at 1.5% means losing $1.50 immediately. That's $78 yearly. Nearly one full week's investment vanishing into thin air. Over a decade, that's $780 in fees alone, not counting lost potential gains. These fees are often hidden in spreads or presented confusingly, so investors don't realize the cost. Two investors, both DCAing 100 weekly, one pays 1.5%, the other 0.1%. After 10 years, the low-fee investor has a noticeably larger portfolio purely from minimizing costs. The solution? Research reputable exchanges with lower trading fees, especially for recurring buys. Advanced trading options often provide significantly lower fees than simple buy-sell features. The learning curve pays off. These 5 commandments for smart crypto investing dramatically increase your success chances. Choose quality over hype, discipline over fear, strategic planning over aimless action. This knowledge transforms DCA from passive habit into an intelligent wealth-building machine you control. Remember to stay the course. There will be times when your portfolio is down and it feels foolish to continue. In these moments, return to the fundamentals. Trust your quality assets, your DCA plan, and your goals. Patience isn't just a virtue in this space, it's the ultimate strategy. Your financial future is built one small, consistent investment at a time. By avoiding these pitfalls, you can harness DCA's true power to build a stronger financial tomorrow. The path isn't complicated, but it requires commitment. Good luck. If this helped you avoid costly DCA mistakes, subscribe for more crypto investing strategies. We regularly share practical tips to help you build wealth through smart, disciplined crypto investing. Like this video if it saved you from expensive mistakes, and comment with your biggest DCA challenge. We read every comment and often make videos addressing your questions.